Hi, this is Steve Hutchinson with Hutchinson Family Offices, and this is our May video. And in this first segment, I want to talk mostly about the month of May is a very special month to me because that's my professional birthday month. And started in this business in 1983, and for 39 years, getting close to 40, 39 years I've enjoyed this business. But during this 39 years, I think it's important to understand the experience of our team and the experience of what we have and how we bring things to the table. You know, shortly after 1983, it was about 3 years, I formed my first independent advisory group. And from that, we've grown into where we are today, which is a family office. But let's talk about the financial markets and what we've seen. And the reason I'm drawing this parallel is I think it's important, given what we have seen in the financial markets as of late. So I want to focus on that in this segment. You know, when I got into the business in 1983, 4 short years later, the stock market crash in 1987 manifested itself, and we saw a one-day decline of 22%. That was horrendous. That was very, very dramatic, and even to this day, there's different theories why the market crashed, if you will. We go back to 1999 to 2000, we had the dot-com blow up. Here people were investing in stocks and companies that had no value whatsoever. We're not even making money, quite frankly, and people were putting a lot of capital. And of course, in 1999 to 2000, the dot-com market crashed. It was pretty bad too. We go to 2008, financial crisis. The shuttering of Lehman Brothers was quite dramatic. And pretty soon what we had found is that the banking system had written a lot of debt on a lot of different real estate and assets, and rents weren't covered. I mean, you could just go parlay this on. In fact, quite frankly, in the memory of my entire career, that was the most dramatic of it. There was actually a day or two there where I was wondering if our financial markets would finish it out. It was very, very interesting, much like the panic in 1907. And then, of course, we most recently, the 2020 COVID crash. This is where the United States government made the decision to shut down the economy. And as a result, the stock market corrected tremendously. In fact, it was one of the shortest recessions we had in the history of this country was during COVID. So I've seen a few crashes, and I've seen a lot of Fed activities. And what I want you to take away from this video is that these things aren't necessarily related to the financial markets per se. What we're seeing now is there's a lot of conversation about the Federal Reserve tightening monetary policy. Now, what that means is they're not going to go out and buy as many bonds. They're going to start selling off their balance sheet, and they're going to slowly or gradually raise interest rates up to a certain point. Well, there are a lot of folks out there that are over here clamoring that the reason the equity markets are performing so badly is because of the potential of the Federal Reserve tightening. Well, we've known this for a while. The Federal Reserve has got to tighten. And they've got a long way to go to make this thing work. But quite frankly, let's take a look at a few numbers that might be helpful. We've had basically 6 different periods in time where the Federal Reserve tightened the money supply. And, that means going through an interest rate. But what's interesting, in every single one of those, the equity markets performed on average pretty good, not so bad. In fact, in 1983 to 1984, shortly after I got into business, Fed started tightening. That was under the Ronald Reagan administration, and we saw the equity markets improve by 13%. We go into 86 to 89. Of course, 1987 is the crash. Federal Reserve was tightening there. The thinking was that the Fed was getting too tight. We had a lot of program trading kicked in, and the market dropped about 22%. Markets actually did pretty well during that tightening of 12.9%. And then let's go one step further. I can go into 94, it was mediocre. Let's look at 1999 to 2000. The market went up 10.5%, another round of tightening. And if we go back to the most recent round of tightening, 2015 to 2018, the Federal Reserve tightened up monetary policy. And at the same time, they tried to lower the balance sheet. This is under Janet Yellen. And the equity markets performed 8.4%. So what I want to remove in your mind, and it's removed from mine, I want to share with you that I don't believe that the correlations between Federal Reserve tightening and market performance are directly related to each other. Valuations adjust based upon investors' perception as to whether the capital is worth the risk. Now, when we take a look at our portfolios, and in other videos we'll talk about that, we are seeing risk-off strategies, which means that companies that are growth-oriented, take a couple of them, Amazon and whatever it might be, pick a few growth companies in there, Google. These companies are finding themselves in a situation where their valuations, or if it may be a little bit high, and the prices are pulling down. So in effect, at the time of this video, the valuation of, or the stock price of Amazon is back to where it was pre-COVID. So does that mean it's a bad company? No, it's still doing business. If it was worth what someone paid for it back then, it's probably worth what it is today. So I think it's important to understand that financial markets do correct, and when they do pull back because of valuation issues in many cases, and a lot of times these pullbacks are Fed-induced. When I say Fed-induced, I mean the Federal Reserve tightens up the money supply, and then investors in the short run get a little bit concerned about it, and we see more selling in the equity investments. At this particular point of this video, we are in a bona fide correction. Now, we're just right smack in the middle of a solid correction. And optimistically, will the market perform from here? I believe so. I believe most companies are still doing business, and we think we're doing well. We have some outside factors that may affect the stock market. Now, one factor we have to talk about in the economy right now is inflation. And inflation does have a parallel to the equity markets, because as the Federal Reserve continues to fight inflation, they do restrict money supply, and this does make the markets in the short run very skittish. In the long term, we have found over the years that many situations with the markets are pretty straightforward. Now, I want to bring up, I've got a report here in front of me that was made available to me by a gentleman, by our team, and I want to kind of go talk a little bit about recessions. Economic recessions are, as a general speak, part of a natural economy moving. So if we take a look, since 1980, there have been 6 recessions and an average of 1 every 7 years. That's it, 6 recessions, average 1 every 7 years. And although the economists have predicted 15 of the last 6 recessions, they've been very good about this. They're always warning about this. The longest recession was really from 2007 to 2009. As you remember, that was where we started getting into the banking crisis, and we saw the economy decline about 5.1% in that particular period of time. That was a tough recession. That was a big one. And then the shortest recession was the COVID-19 shock, which the GDP drawled down in one of the shortest recessions from February 2020 until April 2020 to the tune of about 19.2%. That was a government, if you will, induced recession. We just basically shut down our economy, so it had to do that. The average duration of the last 6 recessions were about 10 months, and the average GDP decline was about 5%. Without the corona crash, if you will, the average decline was somewhere around 1.5%. So generally speaking, we're not as concerned about a recession affecting our clients or your portfolios at this point. We do believe that it will require some adjustments in portfolio to offset the increases in inflation and reducing volatility. We still believe volatility is on the books, but quite frankly, we're not as concerned as you may be hearing in the news, if you will, that these things are starting to create some trends of permanence. So in this, what I'd like for your takeaway to be on this video is to sit down and look at your portfolio. Understand what your performance has been over the last 5-7 years, which has been really pretty good, and realize that the market is in a cycle. It's going to pull back a little bit, And at some point, that cycle will resume the other way. Today, we're seeing a shift into other assets, and those shifts give investors an opportunity to look at investments a little differently. So in other words, where maybe owning certain investments over the last 5 years were out of favor, we're starting to see some of those investments become in favor. So clearly, take a solid look at your portfolio, spend some time with your financial advisor, give us a call if you want to talk about it, or share this video and have someone give me a call. And I'll be more than happy to sit down, assess their risk, and understand exactly what we do. But we do monitor risk very, very carefully. That'll do it for this video, and I hope you have a great spring.